Economic conditions change very fast. A very favorable scenario may suddenly become an unfavorable scenario. This will impact the market also. We are going through such a situation now. Investors have to be cautious and vigilant. Welcome to Geojit Spotlight. At the beginning of this year, Indian economy was in very good shape. GDP growth for FY26 was estimated at an impressive 7.6%. Inflation was mild at 2.5%. Crucial macro indicators like fiscal deficit and current account deficit were under complete control. Foreign exchange reserves were comfortable at $720 billion. Brent crude was trading around $62 a barrel. The fiscal and monetary stimulus measures, that is the income tax cuts and the interest rate cuts by the RBI and GST cuts by the government initiated last year, had started producing good results. Nifty was resilient, trading at around 26,000. Then suddenly all hell broke loose when US and Israel attacked Iran on 28th February. This led to the closure of the Strait of Hormuz and crude oil prices shot up sharply. India, being a major energy importer, became one of the worst affected economies. Initially, the market expectation was that the war would end quickly, but these expectations were proved wrong. With the Strait of Hormuz remaining closed for 2.5 months and crude prices remaining high, all countries have raised retail energy prices. On May 10th, our Prime Minister Narendra Modi appealed to the nation to exercise austerity in expenditure involving foreign exchange. The PM appealed to the people to reduce the consumption of petrol and diesel, postpone the purchase of gold, and keep away from avoidable foreign travel. This appeal was followed by raising the customs duty on gold from 6% to 15%, and today the retail prices of petrol and diesel were raised by rupees 3 a litre, and CNG price was raised by rupees 2 a kilogram. Now, what is the message of all these for the economy and markets? Let me summarize. 1. These measures are temporary. Austerity may not be needed if the West Asian tension ends quickly and crude price comes down. But there is no clarity on when this will happen. 2. If crude price remains high for an extended period, the economy will be impacted. As the chief economic advisor Anantha Nageswaran said, we are going through a live balance of payments stress test. 3. Economic growth will be lower this year and inflation will be higher. This year began with the earnings growth expectation of 14 to 16% in FY27. This will decline to about 10%, can be even lower. This has negative implications for markets. 4. Sustained FPI selling is impacting the market sentiment. Sustained foreign portfolio selling is the consequence of mainly 4 factors. A. Rupee depreciation. B. Low earnings growth in India. C. Much higher earnings growth in countries like US, Japan, South Korea and Taiwan, which are attracting huge FPI inflows. And D. High returns from the US bonds. US 10-year bond is now yielding 4.45%. This makes emerging market equities less attractive, particularly when the currencies of these markets are prone to more depreciation. Foreign portfolio outflows will stop only when these 4 factors mentioned change in India's favor. An immediate trigger can be the end of the West Asia conflict and decline in the price of crude. This can stabilize the currency also. This can happen anytime, but there's no clarity on this, unfortunately. We should understand that the situation can change very fast. Investors have to be cautious and vigilant. Even in a weak market, stocks are strongly responding to Q4 results and the management commentary, both on the upside and the downside. Double-digit increases and decreases are happening on a single day. Buy stocks where there is growth and earnings expectations are good. Pharma stocks are resilient even in this weak market since the sector won't be impacted by unfavorable macros. Importantly, they might even gain from rupee depreciation. Financials are fairly valued. Invest cautiously. Best wishes.